All right, good morning. Today is September 6, 2023, and I'm back with another Wednesday live show. And a lot going on today. I suppose it's starting to feel like fall here, but as you recall, last time I was on, we marked up this chart here with all sorts of fancy stuff and kind of in an interesting spot right now. So let's take a look here. I think I'm going to draw another line from across these highs, at least temporarily here. I think I talked about that last time, about how if the market rallied up and then made a lower high, that I was going to draw a trend line across these highs. So lots of interesting things to see on this chart. For one thing, as we speak right now as we speak, you can see that the price is coming down and testing this 50-day moving average right here. And of course, people make a big deal about the 50-day, but you can see it's sort of zigzagged all over it here, even recently. So I think, well, let's see. Last time we were here, a couple times back, I drew this horizontal area of support, and you remember we talked about this perfect pivot low right here. Well, let's back up a little bit. I guess this would have been late July, this sort of perfect outside reversal day, bearish engulfing candle, whatever you want to call it, was like the short term reversal, and it seemed so obvious at the time, right? And then the funny thing was, a couple days later you got like these little, well, actually the following day, and it looked like it was going to kind of thwart everybody that thought that that was the reversal, because that's a textbook outside reversal day. So anyway, for a few days there, and especially the following day where it gapped up, but anyhow, you can see that it did actually manifest how everyone would have sort of suspected. And then we got the little sell down. What was that, like about 3-4% or something? And then there was this perfect like gap down to end it. That's funny how the rally up ended on a big gap up, and then the reversal pivot candle or bar right here ended on a gap down, and then we rallied up. So anyways, as you can see, let me fix this line a little bit here. As you can see, we've kind of put in another pivot high, and quite frankly, until right now, and it's still early in the day, and so you can't necessarily, no guarantees that that's a perfect pivot high, but if we close lower today, then sure looks like it. Sure looks like it's going to turn out to be a pivot high. So anyways, as you probably know, seasonally speaking, September is the weakest month of the year for the stock market. Most people think it's October, right? But it's actually September. September, seasonally speaking, is weak. So kind of sandwiched in this little, I guess you'd call that a triangle. I suppose it might make sense. There we go. It kind of makes sense to actually connect these two lows right here. And it's basically a sort of major support level. I think when I drew that line, we were closer to the lows, so I drew it as a horizontal line, but now it's like a little wedge here. So, but anyway, I originally drew this upward sloping trend line. Where did it go? Oh, there we go. This goes all the way back to there. That's what I was looking for. Whoops. That trend line goes all the way back to the October lows. So, basically that's they say a picture's worth 1,000 words, right? So there's October, of last year to October of this year. So anyway, September is going to be kind of interesting. It's going to be interesting to see. It's going to be interesting to see how September plays out. Whether we're going to come down and retest the bottom of this end, whether we're going to waffle around up here a little bit. I mean, we're still pretty close to these recent highs, and so the major resistance, overhead resistance level goes all the way back to, let me zoom even further out here. Yeah, see, that's a big deal because that goes back to the beginning of 2022. So if I'm not mistaken, yeah, look at that. Well, let's take it back even further. It's always sometimes I start zoomed in and sometimes I start zoomed out, but this kind of makes more sense because you can see the pandemic sell-off on there, right? And then this crazy subsequent rally. But anyway, I just wanted to take it back further. So here we go. The beginning of 2022. This is when Russia invaded Ukraine, and we got that initial sell-off right at the beginning of the year. So the market peaked up here, as you recall, right end of 2021, beginning of 2022, Russia invaded Ukraine, and we got the initial pretty significant sell-off from 4,800 down here to 4,250, and then that was the first bounce. Like the first couple of rallies in the beginning of 22 took it up to where I have this overhead resistance drawn. And I mean, look at how long it took to rally all the way back up there. There was a lot of zigs and zags in between, but it's, if I go back to that view I had before, as I've mentioned before, it's kind of like a big gigantic cup, and I talked about the potential, or how it actually would be constructive to have a handle on this. So I guess the really big question for the rest of the year. So let's see. We got 1 month, and then there's only 1 quarter left. So the big question of the year or right now, is what happens the rest of the year. And so I've been seeing on CNBC where Goldman Sachs says that the chance of a recession is down to 15% now, and so that's always got to make you nervous. Whenever Goldman Sachs comes out with these big public announcements, it's it's kind of funny. Over the years, it's almost like a contrarian signal, almost. So I remember, I believe it was back here in October. Excuse me, choking on my coffee. Back here in around these October lows, Goldman Sachs, if I'm not mistaken, lowered their year-end price target to 3,600, like right when the market was at 3,600, which was kind of funny. And of course, as you can see, it closed a little bit higher, but right after that, there was this rally. So anyway, all these people have come out recently and said they don't expect a recession. Let's see, Powell said it, Yellen said it, Kramer said it, and now Goldman Sachs says that, there's only a 15% chance for recession. And I didn't catch the time frame. I didn't catch whether it was this year or next year or anytime soon. And of course, the other big debate is whether the Fed is going to raise rates again. So what I was getting at is the market going to get back to the high this year? Because we know that, typically the fourth quarter is pretty strong. And so, rallies kind of come out of nowhere and the market tends to be strong. So we've had such a significant up move already, obviously off of these October lows, but even year to date, right? Like starting the year here, right out of the gate, the market rallied, for January, put in a nice, and it was looking kind of rough here too. I mean, we weren't, if you actually ignore that little sort of, the spike down low in October, like this little congestion area where the market was trading around the lows, was probably around 3,600 or whatever. Rallied up, and then came back down to end the year. So look at that sort of, and this is typical like holiday trading. This area right here, the market just spent couple 2 or 3 weeks just kind of grinding sideways. I mean the moves came in like a couple of days. That down move was just like 3 days, and then this was right around the holidays, right? So that kind of makes sense, around Christmas time, all that stuff. The market was just doing nothing, and even in sort of into the beginning of the year. But as we saw last week or the week before, a whole bunch of the big cap tech stocks just took off right at the beginning of 2023. And so big rally, a sell down to basically retest that sort of congestion area there. Another rally, and then 2 months of just sideways. So April and May were kind of boring, to tell you the truth. I mean, there was not a whole lot of price movement. You can see all these days, just narrow range days where the market was just sort of grinding sideways and not doing anything. And basically this whole area for 2 months here was just nothing. So kind of boring. Hanging in right above that 50-day. So that's when the 50-day was kind of going sideways, and you can see there's like 3 little sort of touches of the 50-day. And then of course, from June, which is a little bit unusual, so we did have the proverbial summer rally. So April and May were sideways, and then June and July were tremendous, which is kind of weird, but it is what it is. So we got the proverbial summer rally, and then of course August came back and retested that low there. So anyway, the 50-day moving average is one of the things that it's so widely watched, and you can see, I mean, it's this orange line right here. It's the 50-day, and you can see that the market, it doesn't really respect it. It's above it, it's below it, it chops all around it. You couldn't possibly use the 50-day as any sort of timing, other than, hey, there's your golden cross right there. The funny thing is that the golden cross, where the 50 crosses the 200, it seems like over the years it tends to happen like at short-term peaks. And the same with the death cross, right? When you get a death cross, the 50 crosses down through the 200, the market's typically extended way down from it. And so the funny thing about it is, whenever I see a golden cross or a death cross like that, the market tends to like revert back. But anyway, as you can see here, there's the 200-day moving average, the blue line, which is kind of creeping up. It's kind of creeping up at a similar angle to this upward sloping trend line. So, I mean, there's no telling here. I would expect that, seasonally speaking, and of course there's a lot of weird stuff going on too. We talked about recent weeks, all year we've talked about, the macro picture and how kind of bleak it is. And I guess the market thinks that everything's priced in, but all these Fed rate hikes are starting to, feels like they're starting to come home to roost. And there was a Fed speaker this morning, and so they're kind of a lot of like well-respected market experts are saying that the Fed's done hiking rates. And so that's a whole nother conversation, because the thing of it is that as I think it was El Arian pointed out this morning on CNBC, the price of oil has gone up dramatically and looks to be headed towards 100. And you got this whole thing with, draining the SPR, Strategic Petroleum Reserve. But anyway, long story short, so everybody's concerned now that this recent increase in the price of oil is going to reignite inflation, and or just cause caused the inflation rate to remain elevated, and the Fed is adamant about their 2% target. And so there's a lot going on. I mean, there's lots of reasons to be concerned because I don't know if you've seen these charts, but I guess it was back in the 70s or something, late 70s, um, when the U.S. had all that inflation, and then it kind of came down, and everybody thought, inflation was whipped. They had these buttons. I remember buttons that said "Whip inflation now." I don't really remember them, but from the time. But anyway, so the Fed is like extremely concerned that the last 12 months of declining inflation rate is going to reverse and the inflation rates start heading back up, and then they're in a real mess. So, and then the funny thing is that the only real tool that they have, I suppose they have two tools at their disposal to fight inflation. And so, the question is like raising interest rates and raising interest rates and raising interest rates. I mean, is that going to, what if they keep raising and, and that doesn't work? So I think it's creating a real mess when it comes to consumer finance and especially mortgage rates and all. But we all know all that stuff. I mean, I'm just kind of repeating what we should already know. So anyways, they're in kind of a pickle. They're in a quandary here, and is one more quarter point rate hike gonna do it? They have just raised rates from 0 to 5%, to a little over 5% in a very short amount of time. And so, everybody's heard of the lag effect. And so my guess is the lag effect is, I used to think it was like 6 months per rate hike. And so all of it could kind of snowball, and these are they at a restrictive rate right now? Well, I would say yes. And so, go back to my point. There's a lot of well-respected market pundits that say that they're done raising rates, or not going to raise again. And so if that's what's priced in, well, if that's what's priced in, then there could potentially be be a shock if they do raise rates at the next meeting. So I think, yeah, they have two more, right? September and December. So 2 more opportunities. So it'll be interesting to see what happens. The thing about oil too is what everyone's talking about this week, coming off the Labor Day. So it was just Labor Day weekend. I think everybody's kind of easing back in. So the macro picture, as usual, as it's been for as long as I can remember. I mean, you can come up with a lot of reasons where, and one is the risk-free rate on, treasuries and bonds and that. And so at 5%, I think, people locking in money at 5%, that's going to double in 16 years, and so you got to wonder if the stock market's going to double in 16 years. So all the decisions are based on what's happening right now, what the rates are right now. So and then of course I've seen a few charts recently that point out that when the Fed starts cutting rates, like when they start to cut, that's when the market typically sells off. And it makes a lot of sense, because it makes all the sense in the world, because the Fed's not going to cut rates until there's something breaks, or there's a problem in the economy, or the economy slows way down, and unemployment goes up and all that stuff. So they're not going to cut rates until the economy's looking really, really rough. And the funny thing is, like, going into this year and the early part of the year, the market was pricing in that the Fed was going to be cutting rates. Remember that? They were going to pivot, and all this and that. And so, a significant part of this rally that we see here was sort of predicated on the idea that the Fed was going to pivot. So Um, and the other funny thing recently is that these it's like a joke now. The revision of like the employment numbers and the revisions of all the different numbers is just crazy. Like they're like nobody trusts them anymore because what's happening is they're coming out with numbers that look good, and then down the road they're revising them and nobody cares anymore, or nobody's paying attention. So they come out and they release like what looks like really good employment numbers, and then they come out and revise them like dramatically, and it turns out that it wasn't as good. So there's a lot of crazy stuff going on as far as like the bigger macro picture, but just zoomed into here, it's pretty obvious where we are. Let me go right here to, so there's a big gigantic support level way down here, and of course you got that rising trend line. So this area, and that's a long way down. I mean, if by chance for some reason the market sold down, you got this first big area of support here. Yeah, call it 43.25 or something, right in this area. Quite frankly, I could draw another one of these instead of just a trend line there connecting those lows, but um, unless something dramatic happens, I mean, there's not a whole lot of big giant long range days anywhere here. I mean, back in the day, we used to see a lot more sort of what I'd call long range days where the market made huge moves or whatever. But lately, it seems like, and this could be, a function of those zero DTE, 0 days to expiration options or something. But the market tends to, and maybe it's the time of year too, right? August is kind of the dog days of summer, so. But there's a couple, what looks like a long range day nowadays on this chart is nothing compared to what we've seen in the past. So we do know that the market can fall a lot quicker than than people expect. So, but anyway, right now this is this little wedge here is sort of the main area to watch, and so we could it could come back in a little bit and bust out of here and rally up here. So keep in mind that nominally speaking, right, like, so 4800 is the old high. If you adjust for inflation, I think the S&P needs to be at about 52, 5300 to actually make an inflation adjusted high, which is kind of an interesting observation that nobody talks about. But anyway, I saw somebody complaining about the price of something they bought at the grocery store. They couldn't believe that, a box of cereal was $8 or something like that. And the funny thing is that, as I've mentioned over and over lots of times here, is that even if the inflation rate, if somehow they manage to get the inflation rate back to 2%, even if the rate of inflation was 0%, right? Um, that doesn't mean that the price of anything's coming down. Everything's going to stay expensive. I mean, it's few and far between. Although, the funny thing is that the price of Teslas, they've been cutting the price of Teslas. I saw a bunch of people complaining about how much they paid for their Tesla and what they're selling for now, and so that's kind of a funny thing. But other than that, I mean, every time I go to the grocery store now, I practically get sticker shock. So it seems like in the inflation, all the inflation that we've seen thus far, that's caused the price of everything to go up. And so, when they do get inflation under control, that means that, I mean, literally, it seems like everything's about 30% roughly, roughly 30% higher than it was a few years back, or call it pre-pandemic. Um, and so those prices are going to remain elevated. The only thing I can think of that would cause like all these big companies to start cutting prices would be if people just quit buying their stuff because they can't afford it. And so I was watching, I don't know if you guys ever saw this thing on History Channel, The Food That Built America, but it's pretty fascinating. It's about all these different brands and how they started in that. And I saw one this past weekend about Fritos and Cheetos and that. And when they came out, and we're talking like, I guess a couple generations ago. I don't know what I always thought a generation was like the lifespan of a person, but apparently a generation's only like 20, 30 years or something because I guess that's when people have kids. But anyway, long story short, so when Fritos and Cheetos were first came out, they were a nickel a bag. And I don't really buy that stuff, but I'm pretty sure that, it's like some crazy price, like 3.69 a bag or something for Fritos. And of course, the bags have gotten smaller. The old joke about, the potato chips now with 25% more air, right? So you got inflation, you got shrinkflation, you got the general price level of everything is probably, and it happened quick. So, I mean, people have been noticing. It's no mystery, but the thing about inflation is the invisible tax, right? And of course, if you studied economics at all, just basic, that the 6 or 7 trillion dollars that the Fed, well, there it is. So you had the pandemic, which was like some sort of, whatever you think about the pandemic, it was definitely like, one for the history books, right? So this sort of era that we're in now will be known for, it's almost like you don't hear much about the pandemic of 1918, but anyway, the pandemic, and that was a 35% sell off in the market, and then the Fed just Powell went in with both bazookas or whatever and created, what, 6 or 7 trillion dollars, and so that resulted in that, and then the repercussions of that. And it was convenient that Russia invaded Ukraine here because that sort of that provided a really nice, reasonable sort of excuse for the resulting inflation. And so somewhere I've got like a little snippet I saved from a famous economist that said something to the effect of, prices rising is the result of inflation, and the old school meaning of inflation was governments create money out of thin air, which lessens the purchasing power of the existing money, which makes complete sense. And so it is what it is. And so the you know the Fed creating all that money, and I haven't even talked about the Fed buying mortgage-backed securities. I mean, that's just a whole nother conversation I'm not going to get into. But the Fed has basically been monetizing the debt since the 2008 crisis. I mean, that's when they started this whole QE thing and all that, and looks like that's my cue to quit rambling on. But anyway, the Fed creating this money, and there's always a debate about it, and they make it so complicated and different things, the way that the plumbing works, they make it just opaque enough and confusing enough that most people don't connect the dots. But the simple fact of the matter is that and we haven't even talked about the deficit. The deficit's going to be a couple $1 trillion. I mean, $1 trillion has been added to the national debt since the past few months. I mean, so fiscal spending is out of control, and you got the Fed, the money supply. I don't know if I believe this, but I saw some stat the other day that said like 80% of the money, that exists in the United States was created in the last, X amount of years. the last 3, 5 years or something. And so, that resulted in inflation. And so they don't like to take the blame for it. They like to pretend that it was about supply chains and demand and the pandemic and Russia and all this and that. But the simple fact of the matter is that the Fed increasing the money supply dramatically resulted in inflation, just like has been happening throughout the history of capitalism. And everybody's wondering what happened. And so I think that quite frankly, and I've heard Powell say that the government spending is on an unsustainable path, more than a few times. He said that years ago. He would say, that, but they don't have any control over Congress spending, and so it's just a big mess. The macro picture is a disaster, but you also have to keep in mind that the stock market itself, the stock market is sort of designed to keep up with inflation, right? And you can go over, big periods of time, and um, you look at other countries that have extreme inflation rates like Venezuela or Argentina or whatever, and so their markets, they go up dramatically, but in nominal purchasing terms, like the purchasing power of the stock market, is kind of designed to keep up with inflation, and so anyway, that probably has a lot to do with where we are, but all that macro stuff aside, it's going to be interesting to see, to see how this thing sort of plays out in the near term. So I tend to get off into these rants about, the big macro picture, but as far as the charts go, and of course, the all the other indexes, look at the Qs real quick. It's a very similar sort of pattern. The thing about the Qs is that you could draw a big downward sloping trend line across here. There's a nice little sort of, this could turn into a bull flag. So it's not going to surprise me at all. It's not going to surprise me at all to see the Nasdaq make, or the Qs anyways, the Nasdaq 100 make a new high. But as much as I like to sort of be, as much as I like to say, well, there's a lot of risks out there too, by the way. And so, if we do get a recession, or if something, if there's some sort of black swan out of the blue, but me, like these big cup patterns, I've been talking about this big cupping pattern for a while now, since it started to look like it was forming. And so these big cup patterns tend to, they tend to form a handle. It seems like we're forming a handle here, and then they tend to break out to the upside. So I'm kind of torn here because I mean the macro picture is kind of a disaster. However, objectively speaking, without knowing anything but looking at the chart itself and the pattern, down the road here, especially the Qs, that's just a really nice clean cup. Um, and a big giant one too. And so it's not going to surprise me at all. Maybe we get, maybe September's is a little rough, and maybe we get a pullback of some significance, maybe not. But it seems like, and it's also hard to say. It seems like that this is probably going to end up resolving to the upside. So anyway, I wish I could have got into more charts and everything, but I got off of my little rant about inflation again. So inflation, but every single day inflation affects me. Every time I go to the store, which is very frequently to get stuff I need, I know the price of stuff. I know what I used to pay. I have a pretty good memory, and I've lived in the same place for 20 years, and so over that period of time, I know exactly what I've paid for stuff, and used to pay for stuff, and the price of everything is significantly higher than it was back in the day. So, and I'm sure everybody else knows the same thing. So the big question is, can they get inflation under control by raising interest rates without, creating some sort of a disaster um, when it all comes home to roost? The thing that I'll leave you with this: the worst thing about where we are right now is that they ended up creating another housing bubble because home prices just don't, go up 20% and 20% and this and that. And so, back before they admitted there was any inflation, I remember seeing like, one year it was like home prices were up 19% year over year, but, the inflation rate was only 1.8%. And I was like, wait a minute, that's, it just doesn't seem, it just seems ridiculous. You can't have home prices rise 20% in the inflation rate. So the inflation, first went into the stock, it went into assets, it went into, the stock market and home prices and all that. And then finally, it went into everything else. So, I mean, everyone knows that the cost of living has been going up their entire life, right? And so they've created a real mess out of it now because the general price level is so much higher than it used to be, and the debt levels are off the charts that, it's hard to imagine. They talk about a soft landing. It's hard to envision a soft landing, quite honestly. Maybe in the near term they can pretend they got a soft landing, but, you know, there's going to be consequences down the road at some point of all the debt that's been accumulated. So anyhow, next week we'll take a closer look at the charts and some stocks and all that. But for now, thanks for joining me, and I will see you back here next week.